Today's episode is about perspective, not chasing noise, not reacting to headlines, but understanding cycles and knowing when to lean in and when to step back. My guest today has spent nearly 3 decades navigating markets across equities, fixed income, real estate, and alternatives across mutual funds, insurance, balance sheets, and even sovereign capital. He's built portfolios, but more importantly, he's built investment thinking. Mihir Vora is the Chief Investment Officer at Trust AMC, and before this, he's managed over 1.3 lakh crores as CIO at Max Life Insurance. His career spans institutions like Aditya Birla Sun Life, HSBC, and so many more, which means that he's actually seen it all: the bull markets, the bear markets, the bubbles, busts, and everything in between. And what makes this conversation especially relevant is that Mihir doesn't just talk about returns, he talks about creative destruction, new age businesses, valuation discipline, and the psychology of capital. Someone who thinks deeply about where growth can truly come from, and more importantly, how investors should position themselves, not just for the next year, but for the next decade. So, in a market that's obsessed with short term performance, this episode is about long term conviction: how to build it, how to protect it, and how to evolve it. So, let's get straight into it. Mihir, thank you so much for joining us today. And, just as I was discussing, as we're looking at the crystal ball gazing for the year ahead, what is in store for the markets? Are we in for a phase of consolidation? Are we going to see some impetus and growth on the upside? And what's the biggest risk for the market?
First of all, thank you, Avan, for having me here. It's a pleasure to be, talking to you again after a while.
Yeah.
Uh, See, I think as we enter 2026, I would say a lot of the uncertainties and the negativities and the, overvaluation pockets, etc., that we talked about last year are probably getting addressed on their own. You know, the markets this year have seen Operation Sindoor. We've seen the worst of tariffs from the US. On the other hand, we've seen the best of the government stimulus by reducing income taxes, by cutting GSTs dramatically, which nobody could think of. So we've seen a lot of action, a lot of uncertainty, a time correction, and a price correction in the broader market. So I think as we enter 2026, I'm cautiously optimistic. Optimistic because the India growth story has not changed. It will never change because there are just too many mega trends in our favor. So long term is always good. But even tactically in the shorter term, because of all this negativity and the time and price correction that we've seen, we are starting from a relatively normal, modest base of expectations. And expectations is ultimately what drives markets. So since expectations are low, a small trigger, a small positive can give us good returns in the coming year.
So, fingers crossed that's going to happen in 2026.
Absolutely.
And I think these global macro conditions are very fluid, be it interest rates, what's happening on the tariff front, the fact that the headlines are changing, there's geopolitical tensions. How do you think all of these global factors are influencing India's equity risk premium and investor sentiment?
Sure. So my base case, for the past many years, has been that the world is in for more of the same, in the sense that the way the Western countries, the Western world, Europe, US, Japan, and even China, which is not part of, have dug themselves into a debt corner, you know. And the debt hole is so huge that there is no way out of it except by printing more money.
Yeah.
So every time there's a crisis or a hint of a crisis, you are going to see more of the same, which is more fiscal stimulus, more monetary stimulus, the Fed put, as they call it. So that's, I think, going to be a reality of life, which means that ultimately liquidity has to remain easy. Currency will keep getting devalued, and you will see money flow into risk assets like equities, gold, silver, etc. Everything which basically hedges against long-term core inflation and money printing. So the liquidity conditions are going to be conducive. That also means that India, which had been ignored for a variety of reasons, and I'll elaborate a couple of big reasons why India was ignored this year. One is, of course, we're starting from a probably a little bit higher base of valuations.
Yeah.
So time correction was needed in any case. But this year, we also saw the geopolitical uncertainties of Operation Sindoor and the tariff issues. Also, equally importantly, China had been an untouchable market for a long period of time. But given the developments around AI, even China came to the limelight, especially after DeepSeek, etc. We saw that the world has been gravitating towards the Mag 7, the tech stocks in the US. And because of AI, so India was never a part of the AI story. So we're kind of left behind in that story. And the countries which contributed to the hardware for AI, Taiwan, Korea, Japan, those also benefited in this whole wave. So 25 was a year in which we were kind of waiting in the sidelines, less in the limelight because of no tech hype around it. But as we are ending 2025, the AI hype is being questioned, and with a little bit of sheen going away from AI, I think money has started coming back to emerging markets. So if you see the last few months, emerging markets funds have started getting money, and India will naturally get its own share as we go forward, provided nothing untowards happen. So I think the FII flows, the geopolitical global uncertainties are there; they will remain, but liquidity and the fact that India has underperformed, relatively speaking, should bring money back to the table.
And despite all that you spoke of and all that's been going on, your small cap fund has delivered over a 10% alpha, which makes it one of the strongest performers in its category. What is it that made it stand out? Is it the stock selection, would you say? Is it the sector selection? Was it time opportunity? And how should investors look at it?
So time actually was the very wrong, a very wrong timing, I would say, not from our point of view, but the market's point of view.
Okay.
So when we launched the small cap fund, it was around end of last year,
Mm.
where the peak of pessimism around small caps was there. So people are saying, "Oh, overvaluation. Are there any opportunities left, etc." But we were very clear that we are growth investors, and the selection that you get in small caps is the widest. If you look at the whole entire market, we have about 5,000 listed stocks, out of which, even if you take a cutoff of 2,000 crores of market cap, there are about 1,100 stocks with a market cap of more than 2,000 crores, right? Out of them, if you remove the top 100 large caps, if you remove the 150 mid caps after that, you're still left with more than 800 stocks to choose from. So we were always of the belief that if you want to make a portfolio of 50, 60 stocks, it's always going to be, a challenge, but it's always going to be possible to find 50, 60 stocks which offer you a good balance of growth. And so it's all been about stock picking.
Yeah.
We've been very focused on our growth at reasonable valuations, terminal value investing philosophy. And we found that these 60 stocks did well for us. And they are across segments. There is no sector bias. There is no, theme bias. They are all stocks which we really are going to give good growth for the longer term, and that's what worked for us.
Absolutely. And that's a very similar philosophy as well that's been in the Flexi Cap Fund because we've observed a relatively lower allocation to large cap stocks. So I'm just wondering, as compared to the peers, as compared to the benchmark, that's a bit of a different strategy. So, what was the thinking behind this positioning?
Sure. So as I said, we are by choice and by genetics, we are growth investors, I would say. The entire team is basically biased towards earnings growth. And by growth we mean earnings growth, not the price momentum kind of growth. Uh, and what happens is that when you're looking at sectors or subsectors or stocks, which in our view or the market's view are likely to grow for a long period of time at good growth rates, they typically tend to be in the mid and small cap segment, because large caps are by definition large mature companies. Some of them, of course, do continue to remain compounding machines. But if you look at the top 100, you'll probably have 20, 25 stocks in that bracket. 75 stocks would be a normal growth kind of a situation. So the choices in our view for earnings growth identification are typically in the mid and small cap segment. So our portfolios tend to be naturally biased towards mid and small cap because we are, as I said, bottom up stock pickers.
So, I mean, if I were just to ask, if someone who is watching this right now says that stock selection is what Mihir Vora is saying is the important criteria, how do I go about that, in terms of what would be your selection criteria typically when you go for some of these stocks?
Sure. So as I said, first of all, our bias is towards growth.
Yeah.
So when we make a rough cut of the market, I said that there are about 1,100 stocks with a market cap of more than 2,000 crores. Of course, we do have stocks below that also, but in general, that's where the portfolio is focused. Uh, Out of that, when we cut it into further subsegments of higher growth segments and normal growth segments, about 600 out of those 1,100 stocks tend to be in the relatively higher growth segment. So that becomes our first cut to start with. Then what we do is then we dig down deeper into the fundamentals, the cash flow, sustainability, the business models, and the qualitative factors like corporate governance, management, promoters. Biggest for us is hunger for growth.
Okay.
Quality, of course,
Yeah.
the way you treated minority
Yes.
shareholders, corporate governance. That's a default. That's the starting point. But after that, what we see is hunger for growth.
Okay.
There can be good companies in a good industry, but with no hunger for growth at the promoter or management level.
And then that would be an avoid.
That would be an avoid, because if you because we are looking at stocks which will sustain high growth for a long period of time, and for that we don't mind paying a little bit of premium. But when you're paying the premium, we need to see that hunger for growth. The framework that we use basically to identify such stocks is our LIM framework, what we call it: leadership,
Okay.
intangibles, and megatrends. So
Okay.
megatrends are macro in nature, they're natural tailwinds, but it's the intangibles and the leadership which basically come to the fore when it comes to stock picking.
That's very interesting talking about, companies that can actually sustain high growth for a long period of time. Because like you said, you're not looking at just the next 1 year. You're looking at the next one decade and what will stand you in good stead then. So when you're looking at the market right now, keeping that philosophy in mind, Mihir, which are the sectors that you think look very compelling for a high growth opportunity?
Sure. So there are, of course, the segments which are decent growth and decent valuations. So they might not be the highest growth, but have good valuations. So financials, in my view, especially the banks, fall into that category, where I believe that the valuations have corrected so much in the last 2 years because of underperformance that even a little bit of growth can give you a good upside. So that's on that normal kind of a category. But the long term trends that we see and the segments that we see which will go at high growth rates for longer periods of time are basically in three segments. One is linked to demographics and income levels. So everything to do with premium services and goods will grow faster.
Hmm.
So whether it's gems and jewelry, liquor, high end housing, bigger cars and SUVs,
So the
the
premiumization.
premiumization service, airlines, hotels, all those premium services and goods will grow faster. Second is again linked to demographics and income levels, is savings segment.
Okay.
So everything to do with savings will grow faster than the rest of the economy and faster than even the rest of the financial services segment. So
Okay.
insurance, wealth management, asset management, broking, exchanges, depositories, etc.
Mm.
Everything to do with the savings ecosystem will grow faster. So that's on the demographics side. Second is, in my view, the physical asset creation theme. You know, India is short of everything physical, whether it's infrastructure, or real estate, or manufacturing capacity, power, defense, everything. We are in short supply. And if we are to grow at 7%, it will not happen without physical asset creation. Only services and only consumption, which have been the traditional drivers for growth for India,
Hmm.
can now probably make us grow at 5 to 5.5%. But if you want to go to 7%, 7.5%, it has to be on the basis of physical asset creation. So cap goods, construction, infrastructure, real estate, defense, power T&D, renewables, all those areas should grow much faster than the rest of the economy. And third is, as we have discussed in the past, the new age companies, new business models, which are either disrupting existing businesses or creating new business models where none existed. So those can have a very large runway of growth, which is what we are ideally looking at.
Absolutely. So, if I were to tap into one of these in specific, and I want to talk about the new age companies, because you have in the past as well spoken about creative destruction and the rise of new age companies. So, how is it that you evaluate these companies? Because we've seen so many of them pop by. Valuations, some would argue, are very unjustified. How do you even value these companies? Because you're looking from a long term frame.
Absolutely. So when you talk about long term, it's, as I said, a combination of leadership, intangibles, and megatrends.
Yeah.
So megatrends we discussed, those are going to be there for a very long period
Yeah.
of time. And companies which spot those trends and use technology to exploit those trends tend to benefit a lot. And what we have seen in these segments is that they evolve into oligopolies or winner takes all kind of a situation. So once you have created a network effect of X million customers, then you can do so much with those customers that they become a entry barrier, a huge moat. So some of these companies have already become so big now that even if s- some billionaire comes and says, I'm going to spend $2 billion and burn $2 billion, it will not be possible to create these networks,
Okay.
these base of customers. So it becomes a natural moat. So once we are, taking that view that these will evolve into a winner takes all kind of a category, then what we look at is the total addressable market. right? Because you're starting, typically a new business model starts from scratch. And when you're starting from scratch and building a customer base, it's important to know what the potential target market is, right? So if we feel that you're starting from a very low base in a very high target market, addressable market, then the requirement of a long period of growth and high growth rates for a long runway of growth can be satisfied very easily. So these are the kind of factors that we look into. So for us, hunger for growth, target addressable market potential, and use of technology. This is what come together to create these network companies, so to say.
Okay, that's quite interesting because there's so many of them, but you've sort of weeded out what will really succeed in the long term. And you've often referred to, the structure thinking frameworks in your investing. You've spoken about dominant gorilla businesses and, stress testing limitations and moats. Tell us a little bit more about how these frameworks help during times of market uncertainty and what the framework is. Explain the whole gorilla concept.
Absolutely. So the concept of terminal value investing, as I said,
Yeah.
is what gorilla investing is all about. And to kind of reiterate, the whole philosophy of terminal value investing is that companies which are expected to grow for a long period of time at high growth rates, their valuations will not be determined by the next few years of earnings or earnings growth. Their valuations will be determined by the length of the runway of growth. So if I were to value the company today, the next few years of profit growth will probably account for only 20% of the market cap.
Hmm.
70-80% of the market cap will be accounted for by the length of the runway and what the market expects the longer term growth rate to be, right?
Okay.
So it's very important to take a view on the rate of growth and the length of the growth runway, then to figure out the next few years. Typically, if you see the analyst reports, they project for 2 or 3 years maximum. But that is so irrelevant when it comes to these, terminal value investing, the long runway companies. So any new age business, any company which is expected to grow at high growth rates for long periods will optically look expensive. So our frameworks take into account the fact that the longer term cash flows and profits are more important for such companies. So that's that one aspect of it. The second aspect we look at is basically, sanity checks. Now,
Okay.
we can also do a reverse check. So suppose today the market cap is X. What is the implied long-term growth rate? Does that make sense? So if the implied growth rate has become 30% CAGR for 20 years, then that's irrational in our view. But if it is saying that this company is going to go at 15 to 20% for the next 15 years, then that is much more doable because we've seen so many examples already in the past. So for a country like India, when the nominal GDP growth rate is 12% or 11% or 13%, it's not very difficult to find companies which are growing at 15 to 20% for long periods of time. We've seen so many of those examples, right? And when the cost of capital is coming down, GDP growth of 6 to 7%, risk premium of 5 to 6%. If you discount a 17% cash flow growth at 12%, you really get good valuations, good valuation multiples possible. So just because a PE for the next year is high
Yeah.
does not mean the stock is expensive. You have to account for the longer term growth rates. So that's the kind of sanity checks and frameworks that we use.
Okay, fair enough. I need to have those checks and balances in place, I guess, Mihir. But let's talk long term. Looking forward, what can investors expect from Trust Mutual Fund? Talk to us a little bit more about the strategies in place. Is there some particular gap in investor portfolios you're looking to address?
Absolutely. So we are one of the youngest mutual funds around. We've got 3 funds launched in the last 19 months. The first one we launched was the Flexi Cap Fund. Then we went for the small cap fund, and then 6 months ago we launched our multi cap fund. So 3 core products are already in place, but of course the investor needs a wider choice. So we'll at least have all the basic mutual fund products in place by next year.
Okay. And tell us, personal journey. You've seen it all. You've been through so many cycles, observing the markets, the booms, the busts, the bull markets, bear markets, the phases of consolidation. How has your own investment philosophy evolved over the years? And is there any particular belief or principle that you think of that you would believe more strongly today than you did, say, a decade ago?
Absolutely, so many learnings. Hair's turned gray. But I
You're
think
just wiser.
hopefully yes, we learned. Uh, I think the biggest learning that in my view, and probably where I'm different compared to what I was 20, 30 years ago, the biggest learning is that you need to be more positive than you think you are,
Okay.
right? Because if you want to work in the equity markets, you have to be a positive a person. You have to have positive frame of mind, because that's what will, you know, that's what will keep you open to ideas,
Yes.
right? Because it's very easy to reject an idea because it's new, so to say. But that's where some of the biggest opportunities are. And I think when I met some of the greats, the investor, the successful people, they have this aura of optimism around them. They have this aura of open-mindedness around them.
Yeah.
And they have this aura of humbleness also. And humbleness not in terms of demeanor, but humbleness in terms of being open to new ideas. They're always looking for ideas. They will talk to the junior most analyst, even though they might be billionaires
Learning
themselves,
every
learning every day, trying to find the next lead. So, yeah, humility and openness to ideas and be positive. It always sounds wise to be cautious and, conservative, but that does not make you money in the equity markets. That's my biggest learning.
Oh wow, I really like that. And you've spoken so much about the emotional quotient,
Absolutely.
which is equally important with the intelligence quotient. And I think on a more personal note, Mihir, over the years, what is it that you would want to be remembered for in terms of your investment style? Would it be for performance? Would it be for discipline? Would it be about shaping a particular way of thinking when investing in the long run?
Absolutely. So, I've been lucky that I've had the chance to build teams many times.
Ah,
So, I've done a startup team, I've done a restructuring, I've set up teams in a sovereign fund, so to say. So it's always been fun to, create that chemistry, because I've seen that, it's not only necessary to put people together. That does not get you performance. Ultimately, that chemistry builds over a period of time. So here at Trust, I this is a place where I can have a direct impact. This is the place where my personal style can get expressed absolutely, because we don't have any legacy. So whatever we are doing is from scratch. So it's our own philosophy which is getting created with the team, with the promoters, and this is what we want to do in terms of creating a legacy. So I think at Trust Mutual Fund, the reason why we come together with the promoters and myself and my team is essentially to build a new institution, and and have our own unique philosophy which can leave a mark on the market, and after 15 years maybe get remembered for having created a successful process driven institution, so to say.
absolutely. And I have no doubt that you will leave that mark, and you guys are doing everything in your power to make that happen. So, wishing you all the best.
Thank you.
But, Mihir, before I let you go, we've got a rapid fire round. So, just, quick, spontaneous, prompt answers, one word answers as far as possible. Okay. What is one word that you would use to describe the next year for the markets?
Optimism.
Okay. The biggest risk for the equity markets next year?
uh, Trade negotiations.
Okay. Top sector for next year, if you had to just narrow it down to your one top favorite?
Banking.
Okay, I thought you would say new age tech, but it's banking. Where do you think that where do you think we're going to see, the key driver for the markets? Is it going to be domestic or is it going to be global?
uh, my guess is it'll be the return of the foreign investor.
Okay. Do you have any regrets maybe in your investment journey?
uh, yes and no, in the sense, I wish I'd read a lot more books earlier in my career.
Ah, okay. One top book then that you would recommend for investors to read. Do you have any recommendations?
Uh, well, it's not to do with the markets,
Okay.
but there's one book called Agony and Ecstasy. It's
Okay.
about the life of Michelangelo.
Oh, interesting.
Yeah, and the way he struggled and came back, and then again went
Okay.
in for a tough time, then again came back. It's so inspiring.
Oh,
No?
wow.
So it's actually not a story of art, it's a story of grit and
Yeah.
passion,
And the
and that's
struggle,
what were really
resilience.
inspiring. Yes.
AI, do you think it's a bubble ready to burst? Yes or no?
uh, Bubble, I don't know, but probably valuations are getting a bit stretched now, whether it's commensurate with the internet bubble that we see, only time will tell.
Hmm.
But as of now, there seems to be a bit of hype already built in, and as we just discussed, there seem to be questions arising out of the same. So
Okay.
probably, we should see some correction in this hype this year.
Okay. Do you have anyone that you look up to in the markets, a guru or someone that you really respect?
There have been many gurus in the market, and the good or bad part about my career has been that it's always been, you know jump into the water and swim.
Okay.
So when we started our careers, there was no very structured mutual fund industry or institutional investing. So whatever we learned, frankly, was from the market. So market is my biggest guru.
Wow. I love it.
And of course, the teams that I worked with, we were always kind of, because there was no, I mean, there was competition, but it was not really cutthroat competition. We were all learning together.
Yeah.
So, and some of the initial, colleagues have become the closest friends.
That's
And
wonderful. Yeah.
that's the treasure with that we have.
Absolutely. Trust Mutual Fund, the years ahead are looking complete the blank.
Sky's the limit.
Wow. Okay. And what's your biggest market learning?
Market learning is stay humble, stay open to ideas,
And stay
and
optimistic.
and be open to change. Yes,
Yeah,
absolutely.
absolutely.
And
Thank-
optimistic. Yes.
Okay, great. See, I've learned already from you, so I'm sure a lot of our viewers have as well. Mihir, that's been so valuable. Thank you so much for joining in with that insight, with that honesty, and with that perspective. I'm sure our viewers will have so much to take home with them.
Thank you for having me, and it's always a pleasure.
All right. And thank you so much to all of our viewers as well for listening in. And we'll see you on the next episode. And what I'm taking away from this conversation is that successful investing isn't about prediction, but it's about preparation. It's about understanding cycles, respecting valuation, and having the conviction to stay the course even when the narratives change. Thanks so much for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.